And so, I've been noticing and operating under the bias that Trump is going to get rates lower. So now we're set up for this, like you said, commodity breakout, an inflationary story. This may be one situation where Trump gets turned on a little bit of his head, or gets turned on his head in terms of demanding that rates go down.
The opinions expressed in this program are for general informational purposes only and are not intended to provide specific advice or recommendations for any individual or on any specific security. It is only intended to provide education about the financial industry. To determine which investments may be appropriate for you, consult your financial advisor prior to investing. Any past performance discussed during this program is no guarantee of future results. Any indices referenced for comparison are unmanaged and cannot be invested into directly. Any references to performance of securities are thought to be materially accurate, and actual performance may differ. As always, please remember investing involves risk and possible loss of principal capital. Please seek advice from a licensed professional.
And we are back with another edition of the Know Your Risk podcast. And this is always my favorite stuff, is when we get to do the interviews, especially with an old faithful guest that's been on with us several times. Always fascinating to talk to him and get his perspective on markets. Mr. Tony Greer has been kind enough to join us today. Tony, how are things, man?
Everything's great, Zach. How are you? Thanks for having me on, brother. What's going on?
Oh, man. Not a lot going on in the world, right? We got some macro action just as I was driving in the office today. Little dust up going on in, not dust up, but little action going on with our friends down in Latin America and Bolsonaro, huh?
Yeah, what happened there? I missed that headline. I've been on call since we picked up.
Okay, Chase has been watching it closer than I have.
I just saw it. So, everyone expected, I guess, Jair Bolsonaro to essentially anoint the Sao Paulo mayor for president, and instead he said he's going to back his son today. So you have the Real getting smacked on that, and people are worried about a little more populism than pro-business stuff coming out. So now you got like ILF and EWZ and everything getting hit.
Wobble is all about today. Got it.
Yep.
Yeah, beautiful. No, I'm loving it. And so before we even get started, everybody knows what we think. Chase and I are on here every single day. If you wouldn't mind, Tone, just kind of set the stage for us as a macro trader and investor. I feel like you're both, right? I mean, don't you consider yourself a bit of both?
I'm somewhat of a hybrid. It's fair to say. Yeah.
Okay. Yeah. Kind of like Chase. Where I'm much more on the investment side, but to me, it's so fascinating. So many different moving parts. You got parts of the markets waking up that we haven't seen in a really long time. It feels like this market is becoming more than just a one-trick pony. You're seeing action in the international markets, all that kind of. But give us the Tony Greer navigator top-down view of how you're looking at the world and your framework for where we are. And maybe you disagree, but our take is that. We believe very much that we have entered a new phase, a new leg, not like in a dramatic way in the sense that this is going to crash or this isn't. We're just big believers that if you want to continue making the kind of returns that markets have been throwing off, especially here in the U.S., you're probably going to need to look in other places. That's our view right now. But give us your framework.
Yeah, man. I agree that you're going to have to look in other places. I think that the U.S. story right now is a really great story, starting from the beginning of the Trump administration, and this isn't anything political at all. This is clearly economic regime change and leadership regime change, right? Where we're throwing, his new national security policy kind of throws climate change right to the curb. Right. And it sounds like a fossil fuel and nuclear renaissance story, and that's kind of following up on all the things that he said that he would do for the economy, which are the only set of things that he seems to be making good on, which is, most important for us. But I feel like he's handed us about a dozen bull markets to chase, and he's not cheerleading the stock market. Right. Like, I don't know. There's something different about this admin for me. And I don't want this to be about Trump, but it's just about how things have changed. Since he took office, we went through that tariff tantrum washing machine back in spring of this year. Right. And so the market is still, in my opinion, working its way out of that. right? And kind of resuming the uptrend that it was in before that. And I think everybody is learning that the tariff story is not going to make the U.S. an uninvestable place, and that all the other things that are going on around us, like, the AI boom, which is certainly getting bubbly now, but it's obviously a massive development that's going to spark, an entire cascade of business decisions and things that happen in other sectors. It's going to affect the energy sector. Obviously, it affects all of technology, but now it's becoming a commodity trade at some level, right? If we're going to be able to fuel this stuff, it becomes a baseload power story. And on top of that, we've got the precious metals trade, right? So that's why, my 30,000 foot up thinking, Zach, and this is kind of something that I've just developed over the last couple of weeks, is that we could be, I feel like that we, at some point, I feel like the NVIDIA/AI bubble has got to have a more reasonable pullback. And I feel like it's just because we're seeing all that circuitous financing headlines and this and that. And it really feels like they're trying to keep the beach ball, in play kind of thing. And I'm not saying that that's necessarily what is happening. It kind of feels like what it is. So if at some point, which I feel like that one sector is so susceptible and everybody's looking at it like a bubble, we let the air out of that, I feel like the commodity sector is set up like unbelievably to see the flows given what's happened. And I think that because, look at the leadership on the year, Zach. We've got gold miners up 150% on the year, leading everything. When has that happened? Right,
2011 maybe. Was it 2010 since?
Right, but it's like a pretty new paradigm, against a backdrop of everybody, rushing their money into AI infrastructure and all of that. And here's another trade that's kind of just taking off. You can call gold the debasement trade or whatever I call it. Having to be in the store of value trade as our fiat currency loses purchasing power. And by that store of value trade, I really mean gold, Bitcoin, gold miners, industrial miners, things like that are backed by hard metal trades. And so I think that given that we see this big shocking difference now where gold miners are up, beating up on everything else, and then right behind it, it's uranium and industrial miners up, 80% almost year to date. And then finally you get to semiconductors, right? But I don't think that the world is nearly as invested in those industrial miners, uranium miners, and gold miners as I think that they may already be in the AI trade and semi trade, right? Like the whole world's got a boatload of semiconductors. It's a question of how many, how much, how big your allocation is, right? And I'm sure that it's gotten bigger given all the positive tailwinds, et cetera, et cetera. Right, we're looking at NVIDIA's market cap and comparing it to like India's, annual GDP. So, it's a real story there. All of that said, and I don't want to take the floor for too much longer, I feel like we're in a super bullish environment for the stock market, given a lot of those positive narratives against the backdrop. When have we seen a metals breakout like this, Zach, with the price of oil sitting there at a very affordable lows of $60 a barrel, $3 at the pump in the US, whatever it is, it's nothing, right? And it's not going anywhere at the moment, which to me makes it even more bullish and necessary to be in those industrial and minor trades, right? Because this is like another benefit just like it's a benefit to the retail consumer having gas at $2.5, $3 a gallon. It's a benefit to the industry who's pulling gold and metal out of the dirt, right? So I feel like that's another setting alongside the business-friendly president that's lowering regulation, that seems to want to, rearrange the global chessboard quite a bit, sets up for a bull market to me. Right? Like I haven't left my feet with that posture in a couple of years now. And so it's just a question of being in the right sectors. And right now I've got our subscribers on my, personal view matrix. We're long gold miners, industrial miners, gold, and Bitcoin. And I'm looking at this as we speak, this breakout in airlines, because I think that the market is okay to trade the breakouts that it's given you. You could have just traded a healthcare breakout last month out of the blue and crushed it. If you were just astute enough to say, hey, look at this thing. It keeps going up. It's breaking above moving averages. The thing won't stop. Like, buy it, right? And it kept going. So I'm just saying, like, the breakouts are working. We had a month of November where leadership changed. The S&P rescued itself from down 5% to unchanged. And the leaders were gold miners, healthcare stocks, biotech, solar, like just a totally different portfolio jumped out in front. And it's like, man, if you're a bear, your ass is red over what just happened. Right. Mm-hmm. And I'm not a bear, but I just kind of try to look at the market objectively. Both sides always have something going for them. And if you're a bear there from down 6% on the month to unchanged, you're like, crumple this trade up and throw it out, right? Like, it's not working and it doesn't feel like it's going to work. So that's the kind of thing that keeps me bullish, and I don't want to steal the floor for the entire radio show.
Hey, baby, that's what we brought you here for. But to follow up on that, what do you think? Because our take has been, I do not buy the mega bearish story. I think when markets are this frothy and they've got parts with them, I would expect to see some air pockets, some hits here and there, that kind of stuff. But our story has been, there is still a lot of things here in the U.S. that we think can rally. We think, we're simpatico with you on the miners, the industrials. Mm-hmm. But our take has also been like, I do, if you're sitting in the indexes like the triple Qs, I think that free ride is over the way it's been. So do you think the indexes are like, do you think the indexes are going to keep doing what they're doing? Or if you want to get that real punchy performance, do you have to go after the individual names? Yeah, you're going to have to be in the right sectors, obviously, to outperform the S&P. I'm not a great individual name trader. I'm an individual name investor, and only when they come to me. Yep. I don't go looking for individual stocks. I look for things in my life that have a ticker behind them that I just want to be long, mm-hmm. Things like that. So I'm not great at individual. They've gone fine, but I'm not great at individual stocks. My bread and butter is figuring out what sectors are going to perform this year and get bigger allocations to those sooner than the investment banks can come out and say, hey, we got to buy this stuff. And so it's worked out fairly well, in terms of the metals and mining and stuff, and getting ahead of that with a beat on the gold markets and stuff. So that is, though, what's amazing to me, Zach, is that it's going to be like we're seeing these delayed reactions of big breakouts in commodities, right? You can almost line them up on the calendar, where obviously gold went berserk first, right? But silver was sitting there at $35 the whole fucking time. Excuse my French. The whole time, right? And then silver went boom, and now all of a sudden silver's pushing $60. But LME copper was sitting there at $9K like a sitting duck the whole time. Whoa, now it's $11K. Right? And now, what's going to happen eventually is we're going to look back in 3 months and say, fucking crude oil was sitting there at $55 and we could have bought it. Mm-hmm. And now the whole commodity thing is gone because uranium's in the lead and people can't get enough exposure. And they've already got all the gold miners that they're going to buy, and now they're chasing industrials. And now the airline and the whole commodity transportation trade is coming to life, and they're buying railroad. Like, that to me is the trade that's lining up for next year. Yep.
Gold miners are up 140% this year. Nobody's got them on the pad. Morgan Stanley just said you got to have 20% of your portfolio in gold. They might be up 200% next year. I'm not joking. Like, I wouldn't sign my name to it, but I sure as hell would not rule that out.
Well, okay. So for a kid that came from a gold mining company and grew up in the industry, I love the fact you said that, because I think that still everybody's like, oh, they've run so much. I feel like this is the most misunderstood sector in the entire market. These guys don't even have $2,000 gold priced in with oil here, right? Yeah. Let alone 4,000. These things are priced right now where they were in 11 when we had $100 oil and $1,900 gold. Yeah, and so. I was reading a CFA. A CFA was doing analysis on them, talking about how they were so overbought. They'd overrun their ski. And I was reading through his research because I love looking at the opposite side of my thesis, right? And Tone, I think what's going on here is that the same stocks have won so long that I don't think there's a lot of people out there that know how to look at these. And he was breaking them down like traditional companies. And I was sitting there going, hey, bud, first of all, you need to understand that the movement, if you're looking at the price of these things versus the price of gold, you need to look at the average selling price over the last 12 months. Okay, you're looking at $4,000 gold. That's not where these cats have been selling it.
Right.
Yeah, that's not where they averaged, right? Their average is probably around 2,900 over the last 3,000 over the last year. And the other part that and I was reading through his analysis, and I think a lot of people misunderstand this fundamentally about most commodity producers. You've got things like energy and things like that, but the beautiful thing about commodity producers when it's running is that they keep pulling this stuff out of the ground at relatively the same price. So as the price of the commodity is going up, their cost isn't going up with it, right? If Apple wants to sell another million iPhones, right? They've got a cost to every single one of those. That doesn't work like that. And I was looking at this guy's research going, you're right, all up until this part, bud. And that's what you're missing. So I'm looking at a fundamental view. It's one of the cheapest sectors I can find out there.
Exactly. Cheapest, under-owned. The portfolio allocation is not even close to what it could be. And if they move it 50 basis points, it's going to be like, the garden hose the Hoover Dam through a garden hose. Excuse me for fumbling that. But Zach, I take a step. You want to talk about something even like at a different level, because I like that you started off talking about tech stocks. And it's like, everybody's owned these. Everybody's been long the NASDAQ. The AI is clearly a bubble of some sort. Not that it can't go on, but it is clearly a bubble. But the technology trade, to me, and I could be completely wrong, but it's getting to the end of its life because we're bumping into transhumanism as the next set of steps, right? The next, what's after AI and into that, it's like, the chip in the wrist and and it's like, whoa, this, I'm not so convinced that that's going to work. I really am not. I'm showing a little bit of my Christian faith here, but I don't believe that people with chips in their arms are real people anymore. And I got a feeling that there's going to be a big pushback against that transhumanism side is going to have a natural pushback in technology. It wouldn't shock me. And so the backdrop to that is, wow, look at the oldest currency on the planet waking up and running before that even happens. And look at the value of metals waking up and changing all as this technology trade matures, right? And we don't have to say, I don't know, maybe there's probably people in tech that'll think I'm crazy for saying it's mature, but I don't know. I was watching it since before it started, so like I was watching it before Amazon was delivering records to my apartment, and I was saying, Jesus, I got to buy the stock. Everybody's going to buy this. They deliver records to your house. This is a no-brainer, right? And so it's like I feel like go through all of that, and now like using AI and talking about very transhumanistic tech on the nearby horizon, I'm like, man, this trade's getting old. So I don't mean to go on too long a run like that, but all that stuff gets into me.
No, and I want to chase stop in here too. But if you look, like I was trying to explain this to some clients, I go, guys, these are great companies. I'm not saying that. Okay, but look, their growth rate, the reason they won is you had these companies with 30 to 50% margins growing revenues at 20 to 30% a year and just kept going, right? Well, those growth rates, you take a look at Apple now, 7% annualized growth, most of that coming from services, and you got 15% margins. We own an airline company that's got better margins than Apple, right? Yeah. And they're great companies, but the issue that we see is you look at them and go, guys, all of that plus a barrel of monkeys is priced into this stuff. You know what I mean? Like, I'm not saying they're going to collapse. They're amazing companies, but where's the juice?
Yeah. Yeah. And then sitting on the other side of it, we've got like energy stocks, which have been consolidating for 5 years. They're like one of the cheapest multiples in the S&P. Oil all of a sudden won't break down any further. And you're like, I can't take your eye off that. And it's like, you want to be long that stuff, or you want to be long NVIDIA at, God knows what multiple going to God knows what multiple. And I'm not a trader that's ever leaned on multiples. I choose to ignore them. But just in terms of what's cheap and what's dear in this market right now, that's, I got a feeling if we put the spread on and shorted some AI and bought some commodities here, we might be okay in a couple of years.
And one more question, Tone, and then Chase, I want you to take it. But
sure.
I think you said something really important that I fully subscribe to as well. And people think it's funny because I'm always Mr. Value and fundamentals and all that kind of stuff. But you don't pay attention to multiples. Now, I'm going to give my stab at why that is because I think correct me if I'm wrong. And it's something that we've tried to explain to listeners. There are so many times, especially with cyclical stocks, that you want to buy them when they look the most expensive, right? And you want to sell them when they look the cheapest. That's one reason. The other time is that really big multiples, the market's a pretty good forecaster, right? Those really big multiples can just be pointing to, hey, buddy, that's because this thing's about ready to blow and it's going to look really cheap in 6 months.
Yeah, you nailed it, man. Like that. Okay. That's more, it's like I'm a more technically driven guy. And if you want to be a technically driven guy, you can't have multiples holding you back. Right. And that comes from a story of literally me being a commodity trader in the 90s, investing in tech stocks that are breaking out technically. And, trying to get some advice from some equity traders at the time, from the different universe, because I'm a commodity trader and I just think these are great things, look great on the charts, the whole thing. And people telling me like, this thing trades at a multiple that's outrageous. And you're like, all right, but like, what's the market cap? Okay, so like, it feels like it can go a lot more outrageous. Like I'm talking about a bull market, you know what I mean? And yeah, I just don't feel like that trading multiples lends itself to really capturing a bull market. It just doesn't.
Yeah, well, I mean, an extreme example of this is the record high multiple on the S&P was at the bottom in 2009.
Oh, Jesus, was that right? Is that right?
Yeah, it hit 90. It hit 90 because remember they had to write off all the bank losses, right? And so it nuked all the earnings for everybody else on the S&P.
Oh my God, that's right.
Yeah,
what a great point, Zach. I didn't realize. Yeah, there you go. It turns the whole argument on its head right there.
Yeah.
So I want to go back. I want to go back to the Book of Revelations here. Talk about bonds. So you made a good point, and I kind of have a two-part question. I saw you posted the other day the Bloomberg Commodity Index breaking out, and it's almost like a commodity breadth thrust where you see, like you said, it is like a daisy chain from gold to other things, and like you see it this last month with copper just starting to rip. I want to know one thing is what do you think is kind of the next commodity in line? Maybe hasn't done it yet that could be next. And then two, I want to know what you think about bonds, because how are we going to get commodities ripping without bonds? Now, this week they've taken some notice, but I want to know if you think bonds become a little bit of a headwind for themselves, but also maybe for equities as we move forward.
Yeah, no, that's exactly how my mind is trying to frame this out, Chase. So it's well thought out. I guess to go. Let me think for a second. So the bonds part is two things, right? Let me just start there and then work backwards. The bond thing is like we're set up for a Costanza trade in the bond market from a perspective that we've been waiting and anticipating Trump to nail his Fed chair. That's going to be the most dovish Fed chair. And then he gets his guy in Kevin Hassett, and then there goes rates higher. Right. So that's one thing that wouldn't shock me. And so put it this way, Chase, I'm also not the world's greatest bond trader either. I'll say that right out in front. I frame the bond market as sort of my speedometer in the equity markets. And so, I've been noticing and operating under the bias that Trump is going to get rates lower. So now we're set up for this, like you said, commodity breakout, an inflationary story. This may be one situation where Trump gets turned on a little bit of his head or gets turned on his head in terms of demanding that rates go down, right? Because those two things obviously aren't going to jive. They're going to try to keep rates lower. But if this commodity breakout continues because largely of his policies, I think, right? There's some really bullish commodity stuff in that new National Strategic Defense Initiative that they just put out, right? It's bullish fossil fuels. It's bullish nuclear. It's bearish all of the old carbon conscious ideas and things like that. And so I think that this lends itself to a bullish commodity setup. So like with the idea that wouldn't it be wacky if we look back when Kevin Hassett gets appointed and all of a sudden rates start trading higher, giving Trump a problem, but that does dovetail with what we can what we're starting to see in the commodity markets, where the commodity trade is in the first and second inning of coming alive, or first or second inning, certainly, of breaking out of this long-standing consolidation. So if I had to guess what could be next, Chase, and it's very difficult, to know, like, to choose from what commodities haven't gone yet, it feels like natural gas, right, just became something, right? It just went from $3.50 to $5. It's been on a rope for like 7 months straight. Right.
You just made Chase's day.
Yeah.
You made Chase's day.
Yeah, that's right in the heart of it, right? And the thing for natural gas is it's very hard for me to forecast, right? It's another thing that I watch and go, oh my God, look at what's going on in the energy sector now, right? And then figure out what trades I should be in. But when I put all that together with WTI bottoming and the precious metals trade, in long or flat only type of upward momentum, like I get salivatingly bullish the commodity complex. So yeah, like I do think that Trump is going to face a lot of headwinds on his idea of getting rates lower if we get headline inflation to pick up. But what's amazing to me is that the powers that be are always able to keep headline inflation out of the goddamn headlines. You know what I mean? And if you pay tuition for anybody, you know that it doesn't stop at any point at any time, the inflation level. So that's how I think I frame that, if that's fair. And what I'm doing, Chase, is I've got more, I'm kind of overweighting commodity exposure, right? The store of value trades is how I want to be positioned going into 2026. And that's very specifically kind of why I end my book in November, in October, and start a new month in November, is because I can kind of start my year early and watch the year turn and then kind of get some momentum from there.
Oh, you got to say way more about that. That's super interesting.
Yeah.
About the calendar thing.
Oh, so I hate ending a year when everybody else does, right? And December is always like, to me, December, it's always like there's usually a Santa Claus rally. But if you think about it, a lot of times there's some kind of an unknown that happens around the turn of the year, right? We had the VIX product blow up that one year, right? There's all kinds of stories in yen Japan as it relates to metals over that big long holiday in the new year, right? There's usually volatility. And I hated that being the turn of my year, where December was the end and January was the beginning. So when I started doing my own P&L, I was like, I'm fiscally marking myself to a different pattern, right? Because I just want that to be something that I observe as kind of November and December are the first 2 years of my volume, or the first 2 months of my volume, and therefore the first 2 months of my P&L. And so I can just observe like the lunacy going into the end of the year, decide how I want to get set up, watch for the turn of the year, and then step on the gas when I feel like that signal develops. And other people are still like picking themselves and dusting themselves off from like the December Jan turn that blindsided them because of this and that and year-end selling, and this fund blew up first and this tax law, and it's like, it's just gone better for me.
So does that have, I was just going to say this, it has played out better, I'm assuming, because you keep doing it, but also, do you have some rules around it? So are you less invested? Are you less invested over December? Do you sit back on purpose and let it play out?
Yeah. You know what else? Do you know what else? Like so it fits into my analysis where I can usually by February or so kind of know where I want to place my bets on how the year is going to turn out. And then it always seems to crescendo at some point before the year end, and then kind of sag into year end, right? So it's like I like to have my book kind of in line with that idea. And it doesn't always work like that, but when I'm looking for the pace, like I spend November, December, January really trying to line up the year, right? Maybe January, February investing, March investing, and kind of winding it down into the fall. Right. And being like, okay, I'm not stretching this whole trade into the end of the year. I think they performed to this level, roll the book over into a new year and go from there. So it's not, it's very idiosyncratic, and people may be listening to this and going, this guy's batshit crazy. And that's entirely possible.
To thine own self be true, though, right? Like, it's like, I feel like I always say to people, like, investing's like golf. You got to figure out what works for you,
Dude, Zach, I could write I should write a book about that one day, because I was an incredibly average to shit trade. Well, I won't say shit, incredibly average trader performance wise until I started TG Macro 9 years ago and really started pursuing my own way of following the markets when I wanted to follow them. And you know what I mean? Like, I spend a lot of time on Friday closes. Like, my favorite time to stare at the tape is like from Friday at 2:00 until like 6, 7 o'clock at night.
Why?
Because it's the most indicative of like what's about to happen, right? It exposes pressure points, right? Like, look at how this thing closed on Friday, right? Like, look at the technical move that was happening. And then on Friday, it saw that, like, it confirms stuff for me. It helps me make decisions. It really does.
Okay, share us. And Chase, I'll throw it back to you, but share a little bit more with us. So, are you saying that do you see a stronger correlation between Friday moves and then carrying through to the following week?
I'll back into it a little bit more for you, right? So I knew that I was never going to be a guy that was going to do the homework from a stock bottom up and pick the winner, right? But I am the guy that can notice this as a little bit, as a competitor, I can notice the markets as competition and as performers and as good places for your money, right? Because the market goes to where it's treated best. So therefore, it's going to flock to these sectors that start performing and continue to perform, right? So my process became monitoring the markets and taking notes of the performance, as in what was winning by how much and what was losing by how much, on a weekly basis. And then on a monthly basis, and then on a quarterly basis, and on a yearly basis, right? So sitting there and paying attention to how that sector finished the week, and then just finished 3 weeks in a row, and then put in this monthly candle, and holy shit, we've got a trade on our hands here, gang.
Okay.
You know what I mean? And it just comes from being diligent about being like, okay, it's Friday, man. Where they close? Like, let's see where the week ended. Let's see what I can look back, measure that performance, stack it up against the last couple of weeks, stack it up against the last couple of months. You start informing yourself by osmosis.
Yeah, I think all it takes for that is whenever you get one of those deep candle wicks and you buy into it intra-week, intra-month or whatever, and the next thing you know, it's gone and it's closed itself better, and you're like, oh, well, I fell for that. But the monthly close, the weekly close, it doesn't lie to you. It's like the truth.
Exactly, man. And especially if you have you have month-end closes that land on a Friday, God forbid, like, it's always like, you see the battle between, long onlys, trying to mark things up, and shorts trying to sit, hedge funds trying to sit on stocks that are breaking down and they're shorting, like, that's a real battle for that settlement price. And you understand why, man. It helps continue the money flow in that direction.
Quickly, I'll ask a FX question. Just mostly, do you have any thoughts on the dollar here, technically, fundamentally, anything?
It seems to be, a consensus short that is behaving pretty well technically, but it kind of stopped breaking down once we named the dollar debasement trade. Once we came down and named it the dollar debasement trade, the dollar stopped going down. There was a pullback in gold, the whole thing. But I'm kind of operating from a little bit of a technically bearish bias. But it's just, Chase, it's also, I should also state that it's not something that I have risk on. Like 10-year yields, it's another speedometer on my sort of, on my risk dashboard.
Tone, do you have any thoughts about if we go through with significant cuts, which looks like that's where we're headed? Couple questions on that. But first of all, do you have any thoughts on if you get deep cuts, how do you think the 30-year responds?
Like I said, I'm not the world's best bond trader, but I would imagine, I don't really know. You would think that eventually they're going to work their way lower, but obviously the curve is going to change.
I was just wondering about, like, Chase and I were saying, the inflation scenario, right? Because like it's perking up a little bit. If you cut deeply, I would expect
people are going to make the case that there's inflation down the road and rates go higher down the 30, right? Yeah. Right. Yeah. And I'm not like I said, not the world's best bond trader, but that seems like something that is definitely a risk.
Yeah.
And if you
Yeah,
look
and
at inflation break-evens and inflation swaps and everything, it's all just been diving. So it's like, it's really interesting to watch inflation swaps dive until this week. Bond yields dive while you see the Bloomberg commodity index rip out. You know, in the as far as the economic data, it's been a mix of good and bad, but there's some stuff picking back up, you know, so it's nothing says like, oh man, here comes the recession next quarter. Like, so to me, all that stuff says like, no, inflation's not dead. So it's just interesting.
I am against hunting recessions. I don't look at them. I don't really go looking for them. And I don't feel like our country is in danger of going through one with like, especially with all the regime change that's going on. So we'll see.
The opinions expressed in this program are for general informational purposes only and are not intended to provide specific advice or recommendations for any individual or on any specific security. Any references to performance of securities are thought to be materially accurate, and actual performance may differ.
Something Chase and I were talking about the other day that I would love to get your take on, and I want to get your take on because I know that you're not reading through stacks of macro data. You know, I mean, you do your homework, but I'm just saying, like, you approach it, you're focused primarily on price and movements and all that kind of stuff. And that's why I want your opinion on this. Okay. So, should we cut? Shouldn't we? Right. So if someone were to ask me, looking at the economy, I'm looking at different numbers, I don't see any reason to be cutting rates significantly here. Now, that being said, I've been the guy saying for years, along with a lot of other people, that we're going to inflate this away. There's no way we're going to get out of this without inflating this away. So then part of me flips around and goes, well, let's party, Bennett. Like, let it run hot. Let it run. Like, right? Go ahead and cut 150 and let's let it rip. And I'll be honest with you. I feel like I got two people pulling on both arms. I'm getting pulled in both directions. And like I said, it feels obscene to cut because of what we would look for typically to look for a cut. At the same time, we know we're not getting out of this thing with fiscal discipline, right? Yeah. So, I mean, hey, let's slip the dogs of war, right?
Yeah. So to address that directly, like, I'm not an economist, but I do look at that and say, when seeing that we are set up to cut, right? Trump putting so much pressure on Powell that literally turned the boat around, you could probably say, right, through his presidency, that we're now moving towards rate cuts. Given where the economic data is, the stock market at all-time highs, it's obscene to cut rates, right? But I don't make decisions. I can only make moves. So my call to my readers at that point was, this is a circus that we're cutting rates. It's comedy, but you can't do anything about it because they pulled a hocus pocus off on the markets that's allowed to say, yeah, we definitely need rates lower. I mean, there's not enough inflating going on, for God's sakes, in my grocery bill, right? So my call was better upsize gold. That's all there is to it right now, right? And we caught an acceleration from that point because that was a while ago when Trump was like, we got to lower rates. And you're like, look at this, the stock market's beautiful, 10 years at 4.5%. Like, what's wrong with this?
Yeah.
And he still wants them lower. And you're like, the inflation's going to happen, dude. And I feel like he knows that. And I think that he thinks that that's fine. And, we're the debt-based society, right? We are inflation, we necessitate it, right? So we need it in order to get out of this. So they're just going to do it. They're just going to create it. And it seems like a signal of when they let it into the headlines and when they don't. But I don't want to get conspiratorial with that. I have no idea if that's the case, but
no. And then when you add all of that too, and you brought up oil, I think one of the things that excites me the most about oil is I still see all kinds of Twitter feeds talking about it trading with a 30 handle, and I love that, right? Yeah. But you add all of this too with where oil's at, and I mean, right? I mean, Katie bar the door.
Yeah. And then, Chase, God forbid the grains move. God forbid the direction of grains changes, right? And creates a problem. Like, God forbid they start following the route of live cattle and like doubling, you know what I mean? Like, that'll be a little bit hairy, but this kind of scenario is okay for the markets.
Where are you at on international?
No, I'm nowhere, man. The U.S. market, Zach, and I kind of stick to the U.S. sectors. the literally the spot commodities. And that's kind of my wheelhouse of trading securities. I keep it super finite. I don't need to step outside of the country. I'm sure that, people are going to tell me that a lot of this stuff is just the dollar going down, and that's why the S&P is going up. But you can still find the best places for your money.
Yeah, no. And yep. And the other side of it too, because obviously we're really big into the commodity thing, but I kind of see, if we're right on the commodity side of it, I kind of see that as a really similar trade to the international.
Yeah,
Especially
it could be a good emerging markets kind of trade. Do you think, like internationally some of those could perk up.
Speaking of which, hey, Tone, have you seen the chart of EEM overlaid over the S&P? You see that breakout?
Yeah.
What do you think of that?
Yeah, it's exactly it, man. It's just like the beach ball underwater. They've been held down forever, and they've been dirt cheap, and they came out of a 3-year consolidation. And in my technical experience, things in a bull market that consolidate for 3 years and break out, they can rally for 3 years. And I don't consider how high they can go. I just don't. I just think it could rally for 3 years, and wherever that puts it, it puts it, right? Like that's literally, I can give you a dozen charts that do that, right? A market that rallies for 3 years, consolidates for 2, rallies for 3, and goes to a price that nobody in the first leg of the rally thought was possible. That's what it looks like EEM is about to do. I wouldn't fade that at all.
It kind of sounds like that time that I thought Nvidia was stretched at 600 billion market cap.
Yeah, right.
Yeah.
Good luck with that.
It still stings, Tone. It still stings.
It's unbelievable. I hear you, man. I hear you. There's no such thing as stretched when we're in this kind of a fiat currency depreciation. It's just a different kind of animal.
Yeah. Boy, isn't that the truth? Chase, before I ask a couple more questions, you have anything to add here?
I'll ask one. We're talking about technicals a bunch. What is your single favorite technical setup pattern or whatever that you look for most?
That's really it. It's when I instruct guys on tactical trading, which is one of my products that I have, and I used to label it as trading lessons, but one of the first things that I teach them is, hunt for consolidations in bull markets. And to back that out, that is literally, like I said, the chart that has been rallying demonstrates that it, can rally for a period of time and then has a small percentage pullback and is consolidating now and holding around the moving averages. Like that's the thing that I sit there like the BCom and not take my eye off of. You know what I mean? And I'm just saying, I remember when Jared and I started our podcast a little over a year ago, we were like, dude, the BCom is bottoming. Like we can just tell they're trying to force this thing down and it's not going. And so since then, it's just put in nothing but a set of higher lows. And now it's breaking out of the top side of the range. You know what I mean? So all that is if you take a step back and look at the BCom chart and what it's doing now, that is literally illustrative of the pattern that I hunt, quite honestly. You know what I mean? It's like bull markets that are consolidating and you've got, a strong bull bear argument, et cetera, et cetera. Then all of a sudden you see the bulls start winning. Those are the breakout. I call it a blue sky breakout. When you have something that usually trades back below the moving averages and consolidates and then gets back above them all. And that's usually when you see trends resume. Or at least for me, it's worth sitting there and betting on them resuming. And if I'm wrong, take my money.
Yeah, the beauty of those big horizontal levels is you know where to put your stop. That's what.
It's
like a
line of defense. And I've spent a little bit of time, getting chopped up in the breakouts, but not giving up on them. And usually you're rewarded. It's something that you got to stay with if you think that that's the idea. You got to try it again another time. And a lot of times, I've been rewarded for being 0 for 2 and then going for it again. And you're like, here we go. Now it's working. And when it's working. So.
Okay. On a little, just switching gears a little bit here. We've talked about the things that you look at, why you look at them, your different way of doing your year end, all that kind of stuff. If you wouldn't amuse me and the listeners here a little bit and tell us kind of your origin story in investing, man. How did you get involved in trading? How did you get into it? Was it kind of, if you can take us back to like the first time you thought, oh, I kind of like this, or I'm interested in this, and then how we got to this point?
It was when my dad used to get home from work and walk up the stairs in our house with like a smile of victory on his face at the end of every day. Right. And my dad was a commuter from Long Island into New York City that worked on an over the counter trading desk for 30 years.
No kidding.
Yeah. Had the same seat at Dean Witter for 30 years till Morgan Stanley bought them when he was running the desk, and he retired with that purchase, with that print. And so every single day from my childhood, he was coming home and like so excited about what he was doing. Right. He came home in a suit, exhausted, and was energized enough to put on running shoes and go for a run, and then come home and eat dinner and go to sleep and get up the next morning, go on the train and do it again. And he loved it. And like, at first I didn't know what a bid offer was, but that was dinner table conversation. Like I remember when he came home and was like, yeah, I got a new stock on my pad. It's called Microsoft. He's like, I don't even know what the hell they do. He's like, I have no idea what it is, but I started trading this thing, MSFT, right? You know what I mean? And it was like, it could have been a widget back then to him. It didn't matter. You know, it was just another ticker on his pad. And he was a street smart guy with no formal education.
Just a natural born trader.
Yeah, he had good, really high street smart IQ and became a natural born trader from kind of like, you know, the hunger of not wanting to lose money. You know, and not wanting to get killed and the survival angle of it. You know what I mean? Like, you ain't taking my chips today, buddy. Like, no, sir.
Yeah.
You know what I mean? Like, no chance. I got to beat on this before you steal my money. No fucking way. Excuse my French. But that's the kind of guy he was. So did you know going into college that this is what you wanted to do? Were you pointed in that direction? No, but like, you know, as a competitor in college, I was like, yeah, like, I think that this is the, you know, the angle that I want to go. I don't know if I really qualify with all these other people that are trying to get jobs at Wall Street investment banks, you know, that are all the straight A students and the captains of the teams and this and that. But my dad was always like, he never believed in any bullshit. And he was like, we'll get you a job on a trading desk. Just relax. Don't worry about it. You know, he knew that he knew plenty of people out there and that at some point we would find a seat for me. And so that was it, man. From there, I started at Sumitomo Bank on the 107th floor of Two World Trade.
No kidding.
Yeah, worked there for 2 years, man. Above the clouds. Unbelievable place to work.
Wow. And so where'd you go after that? From
Sumitomo Bank, I went to UBS for 2 years, traded FX there, spent 6 months in Zurich, which was like 6 of the best months of my life. And then got a job working with Goldman back in New York. That was when I was living downtown in Greenwich Village, working down at 85 Broad Street in the late 90s during peak America. Like, that was a sweet spot in life. It had an even sweeter spot, got married, had a family around 2001 into 2008. And here we are with 3 kids, 1 out of college and 2 in college, and running my own business. So life is good, man.
There you go. Yeah, you probably don't miss the days sitting on somebody else's desk, do you?
No, man. I got war stories. I got scars, black eyes, the whole thing, man. That is a when I look back on the pace that I used to keep, I don't know how I was able to do it, honestly.
Yeah. I feel like that about the first 10 years of building this place.
I can imagine.
You're so proud of it and you're so engrossed at the time. It doesn't look, but you look back at it and go, I don't know if I could do that again.
Yeah,
you know
right.
I certainly wouldn't want to have to. That's for sure. Okay. Mm-hmm. So one other thing too, and then I would like to talk about an event you are hosting that's coming up. Man. But before we hit that, you got to give us one of those war stories. Give us one of those funniest or most crazy trades, war stories, you know, where we're sitting around having a beer, just one of those funny ones that, you know, everybody, I know you've got hundreds of these suckers, but dial one up for us, would you?
All right. There's one pretty cool story in silver when I was at Goldman Sachs, and in the late 90s, you're talking about silver as like a $5 item, $5 an ounce item. To make a long story short, my buddy from Yale DT, I'll call him, is running the silver book. Going into Easter weekend, I guess it was on Good Friday when the commodity markets are open, right? I think it was like the equity markets are closed and the commodity markets open, but we're the only guys in there. So it's a super thin market. We like short staff on the desk. And to make a long story short, the silver is rallying into the close, going from like 475 to 485. And we have clients paying us for silver left and right. So we're kind of getting short into this rally and we're not thinking much of it. And like right after the close, we have a client that asks us for a price and he pays our offer like way above the offer, right? And we're like, whoa, this is after the close now. And then after the close, Phillip Brothers executes 5.25 calls above the market, right? So we're like, oh my God, right? So we get caught a little bit of silver for a period of time here that is extremely treacherous, extremely expensive, and it's literally goes down as one of those lessons that you learn on a trading desk that is so harrowing real time that you literally fear losing your job the entire time. You know, and so things calm down.
How short were you guys? How short were you?
Several million ounces. Yeah. You know, where you don't know, you know, and you're eating Easter, you know, you're showing up to Easter Sunday dinner waiting for the COMEX to open in a couple of hours and your stomach is turning and they're like, oh, would you like some dinner? And you're like, nah, not hungry that time. But as it turned out, we got the position back. We were able to cut it down before we went home by taking some orders off of our pad and things like that. So, you know, there's a lot of ways to skin a cat when you're sitting on the Goldman Sachs sales desk, et cetera, et cetera. So not that there's any magic, but there's ways to manage and mitigate the risk. And we did what we could and lost the money and stayed competitive and made it back over time. And it turned out to just be one of those things that was like, holy shit, man. Like we dodged that bullet, like right through the earlobe, you know, and you felt every bit of it, your heart pounding, your palms sweating, you know what I mean? Sweating through the t-shirt under your desk, under your shirt.
Oh, we've all been,
you know what I mean? Like right down to your belt.
Oh yeah.
The whole thing. So that's like one of the hairy things. There was a lot of money at stake there. I guess the managers that I report to probably would rather that I never discuss that, but it's water under the bridge at this point. We all live through it, live to trade another day.
Now,
there are other ones just like that too.
Yeah.
Zach.
Oh, I was going to say, I bet you've got
like
hundreds
30 of them.
Did you, we've Chase and I have talked a lot about how so many great traders and great investors have to blow up a book first. I've never blown up a book. Having said that, I watched my dad manage money growing up and I bought a home in July of 2006. So I kind of see that as blowing up. That was my book blow up, right? That was my recognition. It kind of had a similar impact on me that I can make a decision to buy something and get absolutely handled. Did you ever blow up a book or was watching your dad, did you learn kind of through osmosis through him?
Well, I always had a sensible approach to risk because I kind of knew I could see what the emotional result was when you got ripped off, you know what I mean? And when you lost money and this and that, and it was like, oh man, you know, and what it does mentally. So I never like had like a massive risk appetite, but yes, I did blow up a book in a sense that like I had a book that I started trading with that I was like, okay, I'm going to put this together and trade out of this book, and turned $70,000 into, and this was during the great financial crisis. And so I was kind of really laying low, like looking for opportunity, but I remember that I put $70,000 into it. And just to have a specific way of kind of trading the market. And I made I probably 4 or 5x'd it by buying puts on the S&P on the way down through the financial crisis, right? In that sell-off, right? In that mix of time. Mm-hmm. And then we got to the lows and I never changed my strategy really. And I waited for the next bounce and I did it again. And I waited for the next bounce and I did it again. And I waited for the next bounce and I did it again. And next thing you know, I was right back to the amount of money that I started with. So that's when I was like, going to close up shop here for a little while. I'm going to take a big break, and I'm going to just work on my institutional sales for a little while rather than trying to mastermind the markets. And you know what was part of my sin back then was that we were literally making money hand over fist as institutional equity brokers. Like we were at the cream of the crop on a really, really good desk that saw a lot of flows, and we all had good deals. And because I was making money in my professional job, I was like offsetting it and saying, all right, it's okay that I lost this money in the markets. We had a great month, right? And so I literally lost too much money because I was making good money, right? You know what I mean? Like it sounds stupid,
No.
but there was a wisdom lesson for me in there because I'm the one that got run over by the freight train of, you dipshit, like you let all this money go out the window while you were, printing money in a bull market industry, in a bull market sector, doing a bull market job. I mean, it was at the end of the bull market, but there was money to be made still in institutional brokering back then. So
I've got almost the exact experience, but inversed. It was, I actually had a good run from the beginning or end of 07 to the bottom in 09. I was up about 25%. And so I was doing good on the investment side, but I purchased a home in 06. So like I was the exact opposite of you. My real life, I was getting slaughtered because I didn't manage enough money. That 25% gain over that period of time, I think I had like 6 or 7 clients. So it was like a tree falling in a forest, right? It didn't matter. And yet in real life, I'm just getting throttled. You know what I mean? You look back on it and you can go back. When I purchased that home, it was 45 days from the ultimate peak in median home prices. And that, I mean, so talk about top ticketing, man. But anyway, hey, tell us about, there's something, we are intending to attend. I've got a lot of moving parts, but we're going to try to be there. I'm looking at the folks you got going to this thing. Heck of a lineup, but give us you got something going on in February.
Man, I'm super proud of this, Zach. We're finally putting together the first TG Macro conference, and I'm shaping it literally in the way that I shape my investment process. I put together my dream team of the people whose content that I consume that help inform my investment decisions and that I follow and listen to and like. I put together my dream team of speakers and they all said, yeah, man, I'd love to do it. And so I'm really blessed with that. And, getting this group together is like a first time that this whole crew has ever, presented together. I think we cover a lot of really important lanes. You know what I mean? Like we've got Brent Johnson to cover the, dollar and debasement trade. We've got Cuppy, he's going to talk, I think, about the AI trade. Grant Williams to cover something, macro like dollar gold kind of thing. Jared Dillian to talk about, opportunity. John Johnston to break down the commodity markets granularly. Doomberg to talk about energy. We have, and then I'm going to speak about like a little bit about my investment process and ideas. And then we're going to do a big roundtable. And I'm really excited because it's in Nashville and you can't go there and not have a blast. So I'm hoping.
How'd you pick Nashville? How'd you pick Nashville?
I've been going there for quite a bit to speak at a conference for a group of commodity traders there. And as it turns out, because of my awesome Cornell network, one of my fraternity brothers and best friends partnered with Richard Branson in the Virgin Hotel in Nashville. And so we've stayed there. We've had boys' weekends there and everything. And I'm so used to going to that place. And I'm like, man, this is a great place to have a financial conference. Like this hotel is perfect. The town is perfect. Everything you draw people from more parts of the state than if you have your little gig on Long Island. So that's why I'm really excited about this. And like I said, like I've been to this place. I've been to Nashville like 20 times now. And I have one good time after the next one. So I'm hoping to tack the conference together in a place where everybody can have fun and make it one of many that we have in a row now.
The thing I got excited about when I saw the list, and I didn't expect anything less from you, but so many of these conferences have talkers, right? Professional speakers. These guys are practitioners.
Yeah.
And so that's, you know what I mean? I was sitting there looking at the list going, oh, I want to hear what those guys have to say. Those are smart cats. And they do it. And as we all know, you know, take your theory and all your smart talk. If you don't know how, if you haven't ran a book, you haven't run a P&L, I really don't have any interest in what you have to say.
Exactly, man. And everyone there, you know, is either a professional money manager or somewhere along the line. I mean, I guess you could say Doomberg is the only author only there, but John Johnston has been, you know, running his own money in commodities for 50 years. Yeah. Right. And you're not going to get more experience and know-how from a guy like that. You know, I run my live view matrix. You know, all of us are running an accountable book at some level. And I suppose Grant is probably the only one that's just a content creator, but it's either money managers or guys running an accountable P&L. And, you know, either we figure out how to make money or we're out of business.
Well, yeah, and even like a guy like Grant. Grant's worked on the desk.
Everybody's got their feet wet in real time experience, and that's what's appealing for, you know, a young and upcoming audience, quite honestly, and why I think that this roster is just a really, really great sale. Like it's great value. You know, like what are dates? How do they sign up? Where do they go? Give us the whole spiel. Oh man, thank you for letting me air this all out, Zach. You're the best. So you can go to my website, tgmacro.com, and maybe you can just put a link somewhere alongside this podcast for that. And there's a link for it right at the top. It has the list of speakers, the dates February 19th and 20th in Nashville. There are rooms reserved at the Virgin Hotel. The price of the conference is $1,250. Like I said, there are 7 speakers on Thursday and a roundtable on Friday. We feed you pretty much every meal in between, and there's a happy hour on Thursday. We're having a dinner on Friday night that is filling up and maybe quite full by the weekend, this weekend. But there's probably still a handful of slots left. That's going to be great networking. And man, I'm trying to throw the biggest party I can for these guys. This roster of speakers is amazing, and I want to fill the room if I can, 300 people.
I love it, man.
That's the goal, man.
Well, I
really
am
hope you guys can make it.
We're in the 90% category, and I don't want to miss that. I don't want to miss that dinner either. So we're probably I was going to tell you, give me a 24-hour lock on a couple of those spaces.
I got you held. You're good,
all right.
man.
All right,
Whatever
brother.
And let's talk before you sign up.
Okay, we'll do, buddy. Hey,
okay.
Tone, great talking to you as always, man. I love your perspective. Love getting your take. You know, no nonsense. Like we've always said, you're a workhorse, not a show horse. And I love it. And thanks for coming on, man. Always good talking to you.
Oh, man, I'm honored, man. You guys are the absolute best. Thank you, Chase. Thank you, Zach. I'm honored to be here. I talk markets with you guys anytime.
All right, brother.
Awesome, Tony.
Well,
appreciate it, man.
Good luck out there, guys. Yeah, for sure.
Yeah, guys, and seriously, it's going to be a great one. Go to tgmacro.com. We're going to put a link on the video. You won't want to miss it. And follow Tony. What is your Twitter handle again? It's at Tony Greer.
Oh, no, TG Macro.
At TG Macro on Twitter. Again, if you trade or invest your own money, you should be following him. If you're not, you're doing it wrong. So anyway, thanks for coming on, pal. You guys, thank you for listening. We will be back on Monday. Hope you have a wonderful weekend. And as always, check us out on social. I'm at KYR Radio. Chase is at Pinecone Macro. You're listening to the Know Your Risk podcast. Download it and subscribe at knowyourriskpodcast.com.
Investment advice cannot be given without a client service agreement. Zach Abraham is an investment advisor representative of Trek Financial, an SEC-registered investment advisor. Bulwark Capital Management is a marketing name only and does not carry a separate registration.